Advisory services offered through VestGen Advisors, LLC, an SEC-registered investment advisor. Securities offered through Private Client Services, LLC, member FINRA and SIPC. Private Client Services and VestGen Advisors, LLC are unaffiliated entities. Any information discussed does not constitute investment advice. VestGen Advisors and Private Client Services do not offer tax or legal advice. People of Chicago, welcome to In the Know Radio with Craig Bolanos, co-founder and wealth advisor at VestGen Wealth Partners. You want help from someone that you can trust, someone who knows what it takes to get retired and stay retired. Today, Craig's going to teach you what you need to know. So get ready to learn something that could change your life. Get connected to the show by calling 833-964-PLAN or go to getretiredstayretired.com. And now, here's Craig Bolanos.
Hey, good morning and happy Sunday to you. I hope your NCAA brackets aren't busted, but you're really wondering about your 401k. Is your 401k going to get busted into a 301k? Well, I want to start today by giving you 6 items, that's 6 for 26, that you should be contemplating, you should be using to make sure you navigate what's proving to be a more difficult environment. And I remind you that last year, our theme for 2025, the investment theme, was one of pragmatic optimism. But as a quick primer, coming into 2026 in January, what we talked about with all of our clients at VestGen Wealth Partners is, hey, there's high valuations, higher stakes. 2026 is going to be anything but dull. Well, you know what? I think check the box on all 3 so far, and we're only closing out the month of March. So what are these 6 things that you ought to be doing for 2026? Well, I couldn't think of anybody better to go over them with me this morning than David. David, good morning. A very happy Sunday to you. And the first thing that you had said on our 6 for 26 is we should buy the dip and sell the rip. David, that sounds a little bit more like trading talk, but I think what you really were hinting at was staying active amid the complexity. So how are we staying active amid the complexity at VestGen Wealth Partners?
Well, we can look at that in 2 different ways. First way for me is if we came into the year overweight risk, perhaps we should trim some of that risk, take some profits on the back of 3 really good years in a row for major stock indices, and perhaps put some of those dollars away for a rainy day. Number 2 is we know when there's extreme volatility in the markets, that usually opens up pockets of opportunity for longer term investors. And while I would argue that the indices are doing okay, not good, but they're doing okay considering what's going on, there are pockets of opportunities in certain sectors of the market today that might offer investors an opportunity to get some good deals. Now, we never want to catch a falling knife. So I think we talk about all the time. We don't want to be the first ones to buy. Let's let someone else kind of validate our thesis. But I think this is not a time for complacency. This is a time for people to recalibrate for the remainder of the year.
David, I think that was very well said. If you're just coming in, we're talking about our 6 strategies. These are the 6 key strategies that you need to be using in order to be successful in 2026. Because remember, we got higher stakes, higher valuation, anything but certain. That's the investment theme that we launched in January of this year. And that brings us to number 2. Number 2 on our list. We've hammered this for a couple of weeks now, but points of entry and points of entry and points of exit have always mattered. So number 2 on our list is going global. We do believe that international, despite the surging price of Brent, which is different than what we use here in the States, West Texas crude, despite the fact that Brent prices have skyrocketed, I think you got to go global. David, give us some talking points as you express them to clients all across this country, because I think it's a matter of concentration risk in the S&P. It's a matter of currency, and also it's a matter of timing.
Coming into this year, the top 10 stocks in the S&P 500 represented 39% of the index. So we're very concentrated with the best names or with the biggest names. And we know that if those 10 names do very well, they're going to pull up the entire index. The concern, however, was if we start to see some deterioration in earnings and those stocks start to lose momentum, they're going to drag down the index. So it's not a matter of being in or out of stocks, but our suggestion was maybe we move a little bit more equal weight so we're more spread out. And two is maybe we have to re-examine our geography. For the last 10, 15 years, owning foreign stocks has diluted performance. You haven't lost money, but perhaps you haven't made as much. And the valuations are a little bit cheaper overseas. Now, we've seen this flight to quality back to the US very recently as the dollar's gained a little bit of strength. But I think the key is if you have zero exposure outside of the US, now is a reasonable time to start deploying a little bit of capital. It's giving folks a second opportunity to do so. So I think there's two reasons. One is valuation. And number two is concentration. And if there was ever a time to be spread out, I think it's today because there are so many unknowns.
Yeah, David. So listen, I think after a 14.6 year run, let's just round that up, everybody, a 15-year run, we're investing exclusively in America, to the exclusion of international. It helped the bottom line of your portfolio. And that's one of the reasons at VestGen Wealth Partners, we have consistently been underweight for more than a decade international. But now that changes. You heard David say the concentration risk in the S&P 500. You heard David mention the dollar, the de-dollarization trade, even though when things get tough, money always flows to the U.S. Again, you talk about Russia, Ukraine. You talk about the events on October 7th. You even talk about the last 3.5 to 4 weeks when we and Israel came together to lead the fight against Iran. Hey, money comes into the U.S. markets, but that's not changing the behavior of central banks, sovereign wealth funds, and attitudes around this world of these countries that no longer want to be as dollar denominated. So make sure you too are getting some monies placed through your asset allocation procedures into the right places overseas so you can benefit from lower valuations and benefit by something else. This trend of U.S. outperformance compared to international or international compared to U.S., a lot of it is always rooted in currency. And these are also secular changes. Secular meaning long-term. They tend to last 8 to 8.5 years. If we're on the forefront of something, this is going to continue for years to come. Listen, right now, if you want to learn more, you absolutely can. Give us a call at 833-964-PLAN. That's 833-964-PLAN. Better yet, go out to our website, GetRetiredStayRetired.com. GetRetiredStayRetired.com. What could be better than that? Not much. So when you go out to GetRetiredStayRetired.com, download right now today our Investment Outlook 2026, or start prepping yourself and your family for something that's incredibly exciting, because the 4th of July, we're not that many days away, and that's when Trump accounts go live. So download for free our guide to Trump accounts so you too can help optimize retirement savings and the freedom of choice for that next generation. Well, David, we've been talking about the 6 for 26 in our A block this morning about buying the dip and selling the rip, being active amid the complexity. We just got done talking about going global, but then that brings us to number 3. A shifting paradigm for portfolio construction, exploring alternative dimensions in private markets. David, you and I have talked about this for 2 years now. 2 years. And relative to that, what I'm suggesting here is, again, this is not a new frontier. It's a different way, though, of getting access. And how can we consider using private markets as a tool to limit volatility, diversify, and help people accomplish their goals?
It's not one or the other, right? So it's not about having pure public market exposure or just loading up on private markets, I often view these asset classes as tools we can use to help generate better risk-adjusted returns. And a lot of times you start to see the value of those strategies when the public markets are experiencing a lot of the ups and downs. So they're playing on the same thematics that people want to invest in today, right? People want to invest in energy. People want to invest in, artificial intelligence. People understand that we need additional infrastructure. And while you can certainly invest in publicly traded companies that are in those industries, perhaps we need to look at some of the private market because A, you're getting access to different opportunities, and B, the return profile tends to be a little bit more steady eddy. So I wouldn't say we're looking at these for outsized returns. We're looking at these to kind of take the edge off, to soften that equity exposure, perhaps increase our income. And there's so many different flavors. It really needs to be customized to you, the end investor.
And David, I think we got to talk more about that when we come back, because I've been so excited about the acronym we call HELP. I think you dubbed the acronym HELP, and I want you to share with everybody after we pay the bills. That's a commercial break, how you're helping people with that acronym, not just survive retirement, but thrive in retirement. Okay, everybody, you're listening to who? Craig and David Bolanos. This show, it's called In the Know with VestGen Partners on the best station, your favorite station. That's why we call it AM 560, The Answer.
It's more In the Know Radio with Craig Bolanos on AM 560 The Answer, where his goal is to pummel you with financial know-how until you say uncle.
All right, if you missed it, we've been talking about our 6 items for 26. That's 6 considerations that you need to do to have a successful year with your portfolio. Because after all, the 2026 investment theme we launched in January, higher stakes, higher valuation. Anything but what, David? Anything but certain.
Dull.
Right? Anything but dull. Sorry. Dull, certain. All right. Synonyms. I don't know. I got to go back and play Boggle or Scrabble, right? All right. One of the things what we've been talking about after we stay active amid the complexity, after we make sure we're really looking at a global footprint. Number 3, we're talking about the value and the benefit of some people adding private markets. And David, I teased everybody, what is this HELP acronym and how can we apply it to investors? Because I got to tell you, the HELP acronym is working so far year to date.
Yeah, HELP is our acronym for infrastructure investments. So the H is hard assets. A hard asset base provides tangible foundation for enterprise value. E is the essential service, right? Something that we need on a daily basis. L is that long-term visibility. And when we're investing, right, we want long-term visibility from a cash flow perspective. And then P, privileged position, privileged market position with a hard to replicate asset, something that is unique that not everybody is going to be able to copy. So I wouldn't say, again, that this is the massive growth asset class. This is the slow and steady asset class that people might want to participate. But when you think of that hard asset, you think energy exposure, right? You think digital. These are the things that still have momentum today. And some of them have actually been accelerated by some of these new political environments that we're in.
Most definitively. So remember, when you're doing private markets, you can apply that HELP acronym that we just talked about to the infrastructure piece, because everybody knows investing in energy, investing in digitalization, investing in these components based on everything happening in the world is an undeniable secular trend. Some of it powered by geopolitical risks, some of it powered by changing international relationships, but a lot of it deeply deeply rooted and powered by something that's an undeniable trend in and of itself, which is all things AI, not alternative investments, but all things artificial intelligence. And David, on that note, the speed of adoption is so fast. I look at what's coming that's already here and what's coming quicker than people realize, the speed through which autonomous vehicles are going to be adopted for what I call transportation. Talk about the picks and shovels of AI, because there's different ways to participate in this changing dynamic.
Picks and shovels to me is thinking outside of semiconductor markets. So the big semiconductor stocks are the stocks that have really carried the market the last several years. Those are those big technology names that a lot of people, quite frankly, already own in their 401ks and their IRAs. When we think picks and shovels, we're thinking of all of the other companies that create value and that are necessary to make those semiconductor companies go. So it might be the boring stuff, but it's the fiber optics, it's the networks. How are people using AI? They're using it on their phone, right? They're going and using different type of search engine capabilities. That's how we view AI. And I think the picks and shovels. I think we just got to follow the money, right? We need $106 trillion. That's the estimate over the next several years through 2040. It's about $3.5 trillion of annual spend on infrastructure. And I think there's a widely held philosophy out there that many government agencies don't have the money to do that. So it's going to be private companies or publicly traded corporations that step in to fill that void. That's the opportunity set that we're talking about. And I would also add, Craig, just think of energy demand. We talked the other day, energy demand the last 2 decades has been pretty stagnant, meaning that, when you have those more energy efficient windows or energy efficient appliances, that actually was kind of working the last several years. But the projection of energy consumption moving forward is through the roof. And that's why we see on the 10 o'clock news all the time, there's board meetings for local boards talking about whether or not they want to have a data center built right next to their house. They're afraid their energy prices are going to go up.
No, 100%. So bottom line is this. I want you to get some help. That's an important acronym I think you need in this environment. 833-964-PLAN. 833-964-PLAN. Go out to our website, getretired.stay-retired.com. When you're on that website, download our useful guides like Investment Outlook 2026. Download our 2026 tax planning guide, or attend. If you're interested in learning more about what VestGen Wealth Partners does, attend an event. David, what do you talk about at some of those financial planning events that you've been leading throughout the Northwest suburbs?
We talk about what it takes to get retired, right? We don't prognosticate as to what could happen in the stock market. We talk about something that's, I think, far more practical, which is how we start coordinating and creating synergy amongst all of these different things related to retirement. Because retirement is not, to me, about making one or two big decisions. It's the coalescence of making a lot of small decisions. It's linking your investments to your tax return, to your retiree healthcare, and eventually to your estate plan. And I think being a good steward of capital just means you're a really good student of the game. So I'm not going to answer your question directly, Craig, because it's not just one thing that we talk about. We talk about a whole bunch of different stuff because it's a lot of work to get retired, and it's probably even more work to actually stay retired.
That's right. So if you want to attend an upcoming workshop, I want you to call 833-964-PLAN. That's 833-964-PLAN. Go out to our website at getretired.stay-retired.com. We're talking about our 6 for 26 for those of you who are keeping score at home right now, counting on your fingers. Number 1, stay active amid the complexity. Number 2, make sure you're going global. Number 3, make sure you're leaning in and embracing the shift to have some private market exposure for those who qualify. And number 4, Quality takes the gold. Yes, it's a play on the fact that it was an Olympic year, but investing in cash cows, those companies that focus on attractive price to free cash flow, who have high ROE, the proof is always in that tax return, David, because when we look at page 1 of that tax return and we're looking at dividends, Dave, when we compare the 2023 to the 2024 to the 2025, what do we notice about the dividends when we're investing with cash cows?
We should see an increase in that dividend income because we are not just buying the highest yielders. We are buying companies that have a demonstrated track record of growing that dividend to you, the investor. And why is that important? No one believes the real rate of inflation is trending at 3%. The responsibility of the retiree is to protect their purchasing power long term. And a good way to help boost your inflation hedge is to have a portion of your dollars in those dividend growing equities.
Absolutely. Dividend growth is where it's at. And dividend growth comes from those great companies of America or around the globe that have wide moats, great management teams. They understand what their fiduciary responsibility is to shareholders, and they're not paying out cash dividends from profits they earned in the past. They're just free cash flowing those dividends here and now because their businesses don't get interrupted by a simple change in a commodity price. I think that's really key to have in portfolio construction today. We're talking about the 6 items you need to have in your portfolio for 2026. And if you want to learn more, you can. 833-964-PLAN. Go out to our website at getretiredstayretired.com. Number 5 on our list. David, you wrote staying retired and dry powder, bolstering cash reserves. David, give us a little bit of a tease, because I don't know that we'll complete the topic, but what do you mean by bolster cash reserves, have some dry powder, and then maybe what we'll do is we'll talk about how at VestGen Wealth Partners, we have the ability to create those cash flow reserve accounts to have good governance.
Our number one for 2026 was staying active amid complexity. It's hard to be active if you don't have any dry powder, right? Because you want to be opportunistic. So I think the takeaway is you want to make sure that you have some money for a rainy day. But as a secondary objective, when there is volatility in the world, you want to also provide yourself an opportunity set to take advantage of some of that volatility, because that is where the real money is made.
Amen. 833-964-PLAN. GetRetiredStayRetired.com. That's GetRetiredStayRetired.com. Download for free today our Investment Outlook 2026. Download for free your definitive guide to Trump accounts, because those are coming. We're within 100 days, and we want to connect with you in person. If you want to go to a workshop, give us a call. We can get you on a list for an upcoming event that we'll be holding. You're listening to who? Craig and David Bolanos. This is In the Know with VestGen Wealth Partners on your favorite station. Station with all the answers. AM 560. We call it The Answer.
You want more In the Know radio? You want more In the Know radio? You can't handle more In the Know radio. Okay, yeah, you can. And it's on AM 560, The Answer. Welcome back. Here's more with Craig.
Let me recap them for you. Number 1, make sure you're staying active amid the complexity. Number 2, pay attention to currency. And that's one of the reasons that besides currency and valuation, you need to consider going global. Number 3 on that list is not so much a new asset class, but a different way to access private markets, not to take on risk, but to focus on that acronym that David said of help, to help you get the results amid the complexity of higher stakes, higher valuations, anything but certain. We're talking about the stock market. We just talked about investing in cash cows because you want to be growing your dividend income. And if you do it right, your tax return is going to prove that out year after year after year. Because after all, if you don't have a plan to grow your income in retirement, how are you ever going to keep up with the surging property tax bill you get from Cook County? If you don't grow your retirement and income during, over your retirement lifetime, how are you going to keep up with the high cost of healthcare, food, whatever it might be? Now, we've been talking about number 5 on that list. Number 5 on what we affectionately call the 6 for 26, bolstering cash reserves. David, when we're constructing financial plans, people are doing them through cash flow modeling. They're living off the interest, the dividends, the payments, or people are using more of what we call the bucket of money approach that also became popular. Talk to me, when you sit in the conference room with a client, how do you determine with them how much money you're going to keep in cash flow reserve strategies specific to them?
Yeah, I mean, it's tempting that to want to put every dollar to work, but as we talked about earlier, right, you fix the roof when the sun is shining, meaning you rebalance portfolios when markets are near all-time highs. You don't want to be scrambling when there's all this market volatility. So, it's different for every family, but what we're trying to do is we're trying to reverse engineer what someone's monthly distributions are going to look like. So if someone's taking out $5,000 a month, $60,000 a year, we're probably going to want to have several years of that cash flow lined up and ready to go. Why? To buy you some time, right? To buy you some time if we're in an adverse economic or market situation. And what we're doing then is, once we determine how many years of that safe capital that we're looking to protect, there's lots of different strategies we could use. One of the basic strategies we might use is we just ladder out some fixed income. So we stagger the maturity dates so that at every year or every 6 months, we have money coming due to support that monthly cash flow. And the reason we do that is we're trying to help create some defined outcomes.
And David,
without having to purchase a product, right? We're customizing it to you.
And David, I think that's going to be so incredibly important, because we need to pause there. And we need to understand. I was talking to somebody from the radio recently. This program goes into multiple states. And they had said, well, talk to me more about how VestGen Wealth Partners does bonds differently than, say, my current advisor, who just has me in the aggregate bond index. And the reason I think that's more important is I talked on the radio this morning on a different show I do, where I said, hey, you have to pay attention to the 3 and the 5 year tips. For those of you who don't know, tips are Treasury inflation protection securities. And what we've been seeing is that 3 and 5 year tip break even, which is a good predictor for the amount of embedded inflation that will be here 3 and 5 years out. It's the highest it's been in 36 months. And I think it's important because that TIPS market, the Treasury Inflation Protection Securities, there's an old adage when it comes to investing that the smart money is always in the bond market. It's not that the smart money is in the stock market. That's where the fast money is. The smart money is in the bond market. So when I start seeing 3 and 5 year tip break evens anchoring at the highest rate they've been for 3 years, that tells me something. And it should tell investors all across this nation that they shouldn't be average with their fixed income. David, fixed income and bonds, we've always said that bonds are for ballast. So talk about platform of how people should be accessing bonds in addition to their broad-based ETF or fund components.
Sure. I mean, I think the key is, over the last 5 years, fixed income returns have been relatively flat. And the concern for investors has been, traditionally bonds have moved in an opposite direction of stocks, but that hasn't been the case recently. And that's where some of that concern has come from. So the platform, it's not a one size fits all, but if I was going to retire, and we eat our own cooking here, so our money's invested the exact same way as our clients' money. If I was going to retire and I knew I had to take out a specific amount of money, our platform allows us to ladder out municipal bonds, corporate bonds, treasuries, you name it, in a portfolio, which means we own the individual bond, no expense ratio on that. And we define what those maturity dates look like. Why is that important? What's the maturity date on a total bond market ETF? It's a trick question, right? There is no maturity date. We don't want that risk. Like coming into this year, no one expected yields to move higher, right? We came into this year, Craig, saying we're going to get a new Federal Reserve chairperson. They're going to cut interest rates. Like everyone's thinking that's what's going to happen. Now the opposite is occurring because of inflation. The way that you can mitigate some of that inflation risk, AKA interest rate risk, is you got to go to a place like VestGen where we have a larger platform to ladder things out, because then you have some certainty in a portion of your portfolio. It's hard to create that certainty on the equity side of it, but it's a little bit easier to create those defined outcomes on the safe money side. And I think we do an excellent job of doing that because we have such a large team behind the scenes.
833-964-PLAN. That's 833-964-PLAN. Go out to our website, getretiredstayretired.com. That's getretiredstayretired.com. America, pay attention to what we just said. You got 3 and 5 year tips that are having higher break-even rates. That's an indicator that inflation is embedded. We are not getting to that Fed 2% target. And remember, the enemy of bonds, the enemy of fixed income is higher inflation or higher rates. This Fed's dual mandate of maximizing employment and maintaining stable prices just got more difficult. So when times get tough, you turn to the experts. That's why we exist here at VestGen Wealth Partners. And you can complement those broad-based bond funds or ETFs by creating permanence and definition, by having fixed income held in such a way that you know when you're getting your money back. You know exactly how much interest you're going to collect along the way, and you don't have to worry about bond prices moving up and down because principal gets repaid at maturity. And if you're thinking to yourself, why don't I have access to defined maturity fixed income products today? Simple. It's because your advisor doesn't have capacity, or your robo-advisor needs to have a scalable solution that just works across the masses when you deserve something as unique as you are. I encourage you to connect with us to learn how you too can elevate your fixed income game. That's 833-964-PLAN. That's 833-964-PLAN. Go out to our website, getretiredstayretired.com. Well, if you're just tuning in, we've been talking about our 6 items for 26, 6 things you need to do to be successful, whether it's staying active amid the complexity, whether it's going global, whether it's that paradigm and investing through innovation using the acronym HELP of hard asset essential services. I won't finish it in the interest of time, but infrastructure is so key. Beyond that, quality takes the gold, bolstering cash flow reserve accounts. But what's number 6? Well, I got to tease you. You'll hear about that when we come back. You're listening to Craig and David Bolanos. This is In the Know with VestGen Wealth Partners on AM 560, The Answer.
Would you like a dose of knowledge? Good, because Craig is back and about to fill your retirement prescription. Back to In the Know Radio on AM 560. The Answer.
So rounding out our 6 for 26, remember today's investment theme, meaning the investment theme for 2025, pragmatic optimism. Got that one nailed. 2026, high valuations, higher stakes, anything but dull. I think we've been spot on so far through the month of March. But number 6 is this: returns come back down to earth. Now, don't let that shock you. Don't let that disappoint you. And when I say number 6 on our list of 6 for 26 is that returns come back down to earth, that doesn't mean that markets decline, but it does mean that when you start the year with elevated PEs, price to earnings, and you remain dependent on assistance from the Fed, the Federal Reserve, you require productivity gains continuing to come from artificial intelligence. You're also dependent upon the massive amount of tax refunds and deregulation from this administration. You know what it adds up to? It just means there's not likely going to be any multiple expansion in that PE. And if there's not multiple expansion, that means the growth in stocks has got to come from earnings only, not multiple expansion. And I got news. Stocks don't normally move at double-digit earnings growth. Earnings growth are typically strong single digits. And that's why we talk about focusing on generating dividends, on generating income. But remember, everybody, all of the stimulus that has occurred, going back to 2018, the start of the Tax Cut and Jobs Act, which I herald as fantastic because it was the single largest tax overhaul in the system in some 36 years when it came through. And then you had all of the stimulus from the CARES Act. Then you had all of the stimulus from the American Rescue Plan. Then you had all of the stimulus from the infrastructure bill. Then you had all of the balance sheet transactions of the Fed. You had the tailwind that was everything ZRIP, zero rate interest policy. I mean, guys, come on. All of that increased M2, the supply of money. And when you increase the supply of money, that money has to go somewhere. It's called the velocity of money. And that velocity of money went into assets that were what? Real estate, equity markets. Does anyone think we're going to get massive stimulus, the likes of which we've seen that I just listed? I don't think so. We can't even agree to fund TSA, although finally that's gotten done. My point is here, David, when you do retirement planning projections with clients, we've always done them in such a way with full knowledge that in the absence of stimuli, returns come back down to earth or returns come back down to normal. So how are you engaging with clients for those expectations going into the retirement years? And how are we wrapping all of these items up into an investment solution that's going to be durable and sustainable because it's already been proven?
It's a great point because lots of folks do retirement simulations. Websites sometimes offer free retirement simulations. But you got to dig into the details. What are the assumptions that those systems are using? And if the assumptions are suggesting that the stock market is going to perform like it did the last 3 years, while we would certainly welcome that type of outcome, I'm not sure that that is a viable way to do forward-looking planning. And so when we're doing our forward-looking planning, we are doing that forward-looking planning with more moderate returns, higher levels of inflation. And we know that if we plan for the worst, right, then we're going to get to our goal and we're probably going to be ahead because it might work out a little bit better than that. And the key is, as we're doing this, we've got to think of like where are the returns going to come from? To your point, Craig, if we end up with single-digit earnings results from the biggest companies in the world, if stock prices only appreciate a couple percentage points, that means a big part of the return is going to come from income. And that was part of our suggestion to folks is if you're 100% solely focused on growth companies, while we all love those companies, maybe we need to move towards the middle ground and pick up some of those companies that are going to generate additional dividends. Perhaps we can take some risk off the table, remove some of our stock exposure, but move into other asset classes that have higher income, covered call strategies, things of that nature. Because if we end up in a more sideways market, right, that income is going to be what we're going to be living off moving forward. So I think the key is if you've done financial planning, go back and look at what those assumptions you used are. And number two, think about where we're going to generate some additional income. We talk about a ton of them on the show, but we want to make sure it's customized to you. And that is the key, because there's different ways to get this done.
Absolutely, David. So listen, we want to help you thrive in retirement. You don't deserve to survive. And that's going to take the coalescence of all of these services, a multidisciplinary firm, a family office for everybody, where you can have conversations that are more holistic, not just a conversation about your pie chart, but a conversation about your actual cash flow plans, your actual retirement plans, backed by robust tax strategy, estate, retiree healthcare, everything from A to Z. And I think it's important that you focus on some of these strategies that, like David's been hinting to, because there are ways for investors to seek more consistent income. There are ways to seek that consistent income with lower volatility. There are alternatives to equities. There's alternatives to bonds. It just takes an open mind and a willingness to say, how can I elevate my game? Well, you do that by elevating the platform, which is elevating the people and the process that you and your family engage with, because you don't deserve commoditized advice. You deserve something unique as you are. 833-964-PLAN, 833-964-PLAN. Go out to our website, getretiredstayretired.com. That's getretiredstayretired.com. When you're there, download for free today our Investment Outlook 2026. When you're there, download for free today our Guide to Trump Accounts. Guys, we're literally 100 days away from those launching. That means you can set up the next generation already with, boy, I mean, David, imagine what it's like. I'm going to plug Trump accounts for a moment. David, are your kids going to have Trump accounts?
You bet they will.
Do I want all my nieces and nephews to have Trump accounts? Absolutely, I do. I want you guys to have Trump accounts for your family members, because the power of compounding, the miracle of compounding, the eighth wonder of the world. Think about the mathematics, guys. If you can basically fund an IRA that got combined with a 529 plan, starting when children are born or young, at an amount of $5,000 a year every year up until the age of 18, and just let that money sit on the shelf for some 4 to 5 decades, invested in great companies of America, the outcome is limitless. The outcome is great because America is great. So I think these deserve a big nod. David, I mean, talk to me about how you envision using these briefly with clients.
Yeah, I mean, we will max out 529 college savings plans because, we believe in that. We want to capture that Illinois state income tax deduction. But this is the icing on the cake for the kids. And to be honest with you, Craig, while we talk about not being on autopilot for retirement, these accounts are going to be on autopilot for my kids. Set it and forget it. Great companies of America. Compound growth. And when we open up that statement 20 to 30 years down the road, they're going to have a huge leg up on a lot of their peer groups. I'm excited to get those up and running.
That's right. Let's go. I want you to have Trump accounts. I want everybody to have Trump accounts. 833-964-PLAN. 833-964-PLAN. Go out to our website, getretiredstayretired.com. Download your definitive guide to Trump accounts today, and let's get the countdown going. We're about 100 days out before these things launch on the 4th of July, which by coincidence, celebrate America 250. It's around the corner.
Okay, Windy City, get ready to be blown away with a hefty gust of financial know-how. You're listening to In the Know Radio with Craig Bolanos on AM 560. The Answer.
Something I mentioned is I'm paying attention to those 3 and 5 year tip spreads. And from an implementation standpoint, there's a reason for a lot of us. We just made additional allocations into a time-tested process designed for consistency, built around a complementary strategy that has little exposure to interest rate opportunity, or more In this case, interest rate risk, because guys, we're navigating what's going to be a tough policy for the Federal Reserve, geopolitical tensions, AI driven market dynamics. And that means doing a little bit of market neutral investing might just be in your favor to complement those equities, or more importantly, complement those alternatives and fixed income portfolios. I want you to learn a little bit more about what market neutral means to you and your family's 833-964-PLAN. Go out to our website, getretiredstayretired.com. David, we talked about our 6 action items for 2026 in order to put people in a position to be successful. And I want to remind everybody out there that there still remains a path. Guys, there is still a path that remains to a war premium risk that evaporates quickly. Oil prices that come back down once the Strait of Hormuz gets opened. There's a path where the jobs data doesn't fall off a cliff, a path where the strong earnings that we had coming in remain, which means there's a pathway to success for this year, which is a pathway to yes. But the longer this goes on in the world, the more narrow that path becomes. So don't lose hope, but simply go back to what we talked about our forecast for the year to be. Again, that forecast being higher valuations leading to higher stakes, anything but dull. And that's why we want you to get access to the professionals and the advice you need, which we would argue is a multifamily office experience where you have professionals of multiple disciplines all coming together under one roof to serve a homogeneous client base, where you don't just have a advisor, you have an absolute team of advisors backed with the 3 pillars of retirement income, backed with the investments, the cash flow modeling, the financial planning, the taxes, the estate planning, the retiree healthcare, and don't forget long-term care. All of those things can be solved for in a coordinated effort. We want you to experience such. You've been listening to Craig and David Bolanos. That's Craig and David Bolanos with VestGen Wealth Partners. We call this In the Know on our favorite station, AM 560.